Is this the start of crypto winter? A sustained period of low prices and lower enthusiasm, the likes of which we saw in 2018 and 2019? Well, as someone who experienced that brutal winter firsthand, I think it's important to compare what happened then with what we're seeing now. That's exactly what I'll be doing in this video. I'll also be giving you some of my own thoughts on where we could be going from here. So, don't go anywhere. Could you ask whoever's going to the shop to get me a couple of bottles of Beaujolais? Yes, nothing too pricey, but decent. Yes, I'll tell them I'll give them the cash tomorrow. Is this on? Splendid. Right, jolly good. I just want to take this opportunity to state categorically that none of what you're about to see is financial advice. It's purely for educational and entertainment purposes only. The Coin Bureau is home to some of the finest crypto content on YouTube. So if this is your first visit to this illustrious, stupendous channel, then be a sport and bosh the subscribe button and ring the bell too. No idea why, but apparently it's a huge positive for everyone involved. Now, if you're in a rush, then there's timestamps below for you to avail yourselves of. But if you watch until the end, well, I'm sure we can fix you up with a peerage or a government contract of some kind. Right. Anything else? No? Good. Well, if you'll excuse me, I've got some guests round for a knees up, so I'd better skedaddle. Can I get the fee for this in cash? Thanks awfully. Yeah, jolly good. Politics, the art of the next best. So, what was the crypto winter and what caused it? Well, it was the period of extended low prices and low interest that we saw in the crypto markets from 2018 to 2019. It was a period where Bitcoin went from well over 20k in late 2017 to a low of 3.2k in late 2018. ETH fell even harder and went from almost $1,400 to a low of below $100. It was also a time when many of the newer cryptocurrencies that had emerged in 2017 were decimated. The infamous ICO boom led to a massive bust. It was a tough time to be in the crypto market. Not only because prices were in the gutter, but because there was so little interest in cryptocurrency in general. It wasn't until the beginning of 2020 that things started to turn around. So what caused the 2018 crash and crypto winter? Well, there were a few factors, but one of the most likely causes was over-leveraged retail money chasing a bubble that was popped by institutional investors and regulatory FUD. When I think back to those days, there were a lot of stories about these newbie investors who were diving headfirst into crypto. Some of them even took out loans in order to further increase their exposure in the space. While many were buying Bitcoin, there were many others who were aping into these shitty ICOs that were being built on Ethereum. This led to that unprecedented rally that we saw in 2017. Such was the hype around blockchain that there were even companies changing their name to blockchain in order to cash in on it. One of the most well-known of these was the Long Island iced tea company changing its name to Long Blockchain Corp. No joke. Then, at the end of 2017, you had a fundamental moment for the crypto market, the issuance of the first Bitcoin futures instruments on the CME. Many institutional investors were licking their chops at this opportunity, not in order to go long on Bitcoin, but because it gave them the ideal opportunity to short the shit out of a market they saw in bubble territory. These instruments started trading in December of 2017, and almost as if on cue, we started seeing sustained falls in the price of Bitcoin. These were spurred on by the fact that China and South Korea were spreading regulatory FUD in early January of 2018. As prices began to fall, it flushed out those over-leveraged retail traders. More and more of them were forced to close out their positions. There was no more new money coming into the market, so there was nothing to stem the bleed. A long, cold winter set in, and many a shitcoin froze to death. Okay, so that was then. This is now. What's driving the price movements we're experiencing today? Well, whereas the 2018 crash could have been blamed on a number of factors, it appears as if one of the biggest factors in the current crash is monetary policy. More specifically, the Fed is winding back its unprecedented monetary stimulus that it unleashed in response to the pandemic. And unprecedented it was. Fun fact, in the span of 2 years, the Fed printed 50% of all the money that had ever been printed in its entire 109-year history. Truly mind-blowing. As most of you will know, this monetary stimulus was the main driver behind the crazy bull market that we saw in most risk-on assets. In times when rates were near record lows, people were starved for yield and were casting about for it in several places. Since the start of the policy in 2020, crypto has been placed in that risk-on bucket. This can be evidenced by the increasing correlation that we've seen between equities and crypto since the stimulus began. Now, of course, you don't pour trillions into a lockdown economy without having negative side effects. More about that in the description. Anywho, the markets got high on the Fed's supply, and everyone knew that the withdrawal symptoms would be tough. As the Fed giveth, so the Fed taketh away. And this year, Jerome and his buddies made it clear that they would start to unwind this stimulus. The taper tantrum has thus ensued, and by March, we could start to see the first rate hikes in over 2 years. You only need to take a look at the stock markets to see that the crash that we're seeing in crypto right now is not isolated. Those stocks that saw the most growth in 2020 and 2021 are being battered. Even some relatively safe bets are being hit as investors start to adjust their portfolios and move into bonds and the like. The key point to realize here, though, is that this is not a crypto-specific crash. It's global macro factors that are clobbering a whole host of other assets. Markets are reacting to large institutional investors adjusting their positions in response to systemic factors. Okay, so that's a bit of a high-level overview of what's going on in the markets right now. I talked about this in much greater detail in my video on Fed policy and crypto. That's in the top right for you to come back and watch later. I now want to take a closer look and compare the crypto winter and the current market crash, starting with the type of investor. As I mentioned, back in 2017, the investor profile in the crypto markets was very much retail. Individual investors who were speculating on Bitcoin and other high-risk crypto assets like ICOs. Much like any retail-driven frenzy, the investors who were aping in back then were doing so with relatively little knowledge of what they were buying and why they were buying it. They were using offshore and often deeply dodgy exchanges, and many were resorting to leverage trading to increase their exposure. There were also whales in the space, but these were mostly OGs operating in a relatively opaque market. They could control it to their benefit, and many have also pointed to the undue influence stablecoin issuers had at the time too. Today, the investor profile is completely different. It's no longer a retail-driven market. It's become the darling of institutional investors. Just take a look at this chart over here from Kraken Intelligence. It shows the crypto funds under management since 2016. As you can see, in 2017 we were sitting at a little less than $5 billion. Today, we have almost $60 billion as institutions from hedge funds to pension funds and sovereign wealth funds have been accumulating crypto. Now, just to give you an idea of who has been picking up crypto, here is a short list. BlackRock, Morgan Stanley, BNY Mellon, State Street, Point72, JP Morgan, Soros Fund Management, and the endowment funds of Harvard, Yale, etc. Of course, not to mention the slew of high-profile global macro investors who've been loading up on crypto over the past 2 years. In fact, in an institutional crypto survey last year, Fidelity found that 52% of institutional investors hold cryptocurrency. I'll leave a link in the description to my video that covers this report in greater detail. Then, of course, we have all those corporates who've been adding crypto to their balance sheets. Now, while most people are familiar with MicroStrategy, there has actually been a pretty diverse range of companies that have followed suit. These include the likes of Tesla, Square, now Block, Meitu, and a few others. The broader point is that today, those investing in the market are larger, longer-term, and more resilient investors. They're less highly leveraged and hence less likely to sell in large market falls. It's quite the opposite of the 2017 retail frenzy. Okay, so that's the type of investor. But what about the crypto market structure? How are things now compared with 2018? Well, back in 2017 and 2018, the crypto markets were way less developed or as liquid. There were far fewer exchanges, and trading volumes were much lower than they are now. When it came to crypto derivative instruments, they were mostly restricted to these offshore exchanges. It wasn't until the launch of CME futures in 2017 that institutional investors had the opportunity to invest in these linked instruments, albeit for nefarious purposes. There was also very limited support for institutional custodian solutions. If I can recall, in those days, the best available were the likes of BitGo and a handful of others. However, things are completely different today. On the futures side, there's been an explosion in open interest and volume in these futures instruments. You can clearly see the evolution of these in this chart in that Kraken intelligence report. Volumes in the futures market have ballooned over the past year. This has also been the case for those CME futures instruments. On top of this, we've seen the CME launch Bitcoin options as well as ETH futures. We've also had these instruments being launched on platforms such as the CBOEs, Backed, etc. Banks and other market makers have been structuring instruments for their institutional clients to get exposure to these assets, including the likes of JP Morgan, Goldman Sachs, Citigroup, quite simply a who's who of Wall Street. On top of this, 2022 saw the long-awaited release of those Bitcoin ETFs, the darling of the crypto investment hype from 2017 and 2018. Yes, these were not the spot ETFs that everyone was hoping for, but there was nevertheless a massive demand for these instruments. For example, on the first trading day, the ProShares Bitcoin Strategy ETF had over $1.1 billion in volume. Then, of course, you had all those ETF instruments that were launched in other countries, such as Canada, some of which were spot instruments. These include the likes of Purchase Bitcoin, which also has over $1 billion in AUM. When it comes to institutional storage and custodian solutions, they have proliferated. Not only have the traditional exchanges and crypto providers moved into the custodian space, but you also have traditional custodians and banks lining up to make the most of the sector. So it's quite clear that the sector has evolved into a machine that is purposed to serve those institutional clients I talked about earlier. But how has the regulatory landscape changed since then? Well, back in 2017, there were few, if any, crypto regulations. The assets were not really viewed as that much of a threat to the regulators, who allowed people to trade them on offshore exchanges. Exchanges that did not require much in the way of KYC or AML. This lack of regulatory oversight is part of the reason that these fraudulent ICOs were able to run such large fundraising efforts without much intervention. It really was the Wild West when it came to financial markets. That's not to say that regulations and governments could not have an impact on the market. I remember back in those days the threats that came from that infamous Korea FUD. The outsized impact that rumours about Korean regulations or crackdowns would have on the crypto markets. An even larger threat than that, though, was the rumblings of the CCP over in China. Given that China had a near monopoly on trading volume and mining hash rate, if there were any rumours of potential crackdowns, this would throw the crypto market into turmoil. You can see a timeline of all the China FUD here heading back to the beginning of time. You'll notice that the period that had the most sustained fall from China FUD was, of course, in early January of 2018. This was where China was once again clamping down on its miners. The 90-day return from this event was negative 55%, which goes to show how much of an impact it had on the markets. So, with that in mind, how do things look today? Well, it's almost a complete 180. Crypto regulations are all around us. We've had numerous hearings and discussions about them in the halls of Congress and other legislative bodies around the world. Laws have been crafted that look to give guidance around digital asset regulations and tax enforcement. Now, while some of the regulation isn't necessarily friendly, the mere fact that crypto regulation has become a talking point among politicians is evidence of its preeminence. There is a blockchain lobby in Washington. There's a blockchain caucus and pro-crypto politicians who are helping to keep a lid on some of the more onerous regulations being crafted. And it's not just individual governments, but intergovernmental bodies. The IMF, the Bank of International Settlements, Financial Action Task Force, the World Economic Forum. All of these bodies have come out with their own suggestions about how we view and regulate cryptocurrencies. Central bankers have also been having their say, from the Fed to the ECB, the BOE to BOJ. They are taking an active role either in how they view regulations or whether they could be launching their own. More about that in a bit. So it's quite clear that the regulatory landscape is almost completely different today compared to where it was in 2018. I'll also point out that whereas in 2018 China held a lot of sway in the crypto markets, now it is increasingly irrelevant. That's because ever since that mining ban last year, the share of China's mining hash rate has gone from over 70% back in 2018 to 0 right now. China and Korea FUD are historic memes that no longer hold sway in the markets. Okay, that's regulations, but has awareness and adoption changed at all? Well, although there was a lot of buzz around cryptocurrency and Bitcoin back in 2018, it was still not in the mainstream lexicon. I remember back in those days that many of my friends still referred to it as a scam. My girlfriend's father actually thought I was involved in money laundering because I worked in crypto. And no, Tony, if you are watching this, I'm not involved in illicit activity. Now, I'm sure that if you'd been around during that time, then you'll have known some people who thought the same about cryptocurrencies. Even if you did know about cryptocurrency, the chances are that you may have heard about it through word of mouth or because some mainstream article ran a story about how much prices had rallied. There certainly wasn't a great deal of advertising about. The dominant place that you would see advertising for crypto-related services was online, and even then, these were severely restricted. That's because the likes of Google and Facebook came out with crypto advertising bans. When it came to adoption, there were few places that accepted cryptocurrency or planned to ever do so. Fast forward to today, and you have the Staples Center being renamed the Crypto.com Arena. Miami Heat now play at the FTX Arena. Not to mention sponsorships of baseball, Formula One, UFC, etc., etc. In fact, I think it's fair to say that anyone who's not heard about cryptocurrencies today has probably just awoken from a coma. Of course, this large-scale and widespread marketing push has led to a great deal of adoption. This can be seen in the on-chain charts with Bitcoin and Ethereum address activity, both the number of addresses and those that have more than $400 in them. It's not just individual users, though. Companies have been adapting their strategies to make the most of the crypto space. While I mentioned some that have added crypto to their balance sheets, others have either begun accepting payments or completely reinventing themselves as crypto companies. We now live in a time when Bitcoin is actually legitimately a legal tender in a sovereign state. This is something that would have been unheard of just a year ago. And it's not just about emerging countries with unstable monetary regimes. Local governments in developed markets like the US have also started to jump on the crypto train. Cities like Miami and New York are actively competing to see who can attract the most crypto talent and users. We now live in a time when you can actually pay your local taxes in cryptocurrency. Now, I'm sure there are many, many more examples out there. The point is that crypto is quite literally everywhere. So that's awareness and adoption. However, I think one of the biggest differences between 2018 and now is the investment thesis and what one could invest in. Back in 2017, the crypto asset landscape was quite different from what it is today. Back then, the main case for investing in cryptocurrency was that it was an alternative money, an alternative to the status quo. Bitcoin was seen as digital gold and people wanted a hedge against fiat. Ethereum was seen as an alternative, newer money that had programmability built into it. Of course, a great deal of those who were investing in ETH at the time were doing so because of all the ICOs that were issuing on top of the protocol. Some people aped into the likes of XRP, Ripple, at the time, because they were of the view that XRP could be used as a new money. Quite simply, the landscape was about a bet against the traditional financial system. This is perhaps part of the reason why so many in the traditional financial system, Wall Street et al., didn't have a strong investment case for crypto. NFTs were nothing but a cypherpunk's hobby, and DeFi had not even entered the lexicon. However, today, the investment case is as diverse as the range of assets on offer. Think about DeFi, for example. What was once a theoretical construct occupied by degen yield farmers has been transformed into a burgeoning financial sector that hedge funds and asset managers are diving into. TVL has exploded across multiple Layer 1s and Layer 2s. Or what about the transformation of the NFT space? Who would have thought that an alternative money system could completely turn the art, collectible, music, and sports markets on their heads? The insane levels of interest that we see in NFTs right now cannot be underestimated. The cultural appeal of these assets has transcended so many different groups of people. The GameFi space is also exploding as a new form of digital ownership is overtaking the status quo of walled gardens. More about that in the description. The metaverse isn't just a meme either. Facebook has bet its entire business model on the space. Just think about that. All of these NFTs are built on blockchain infrastructure, minted, traded, and stored. It's no longer about an alternative money, but an alternative system, a new internet of value that investors are wide-eyed about. Everyone is dying for an alternative to the Web 2 status quo, and the decentralized technology that's being offered by crypto and blockchain tech is the alternative that they seek. This is why VCs, angels, and institutional investors are throwing so much money at the sector. They foresee immense opportunity in the Web3 startups building in the space. By the way, if you want more of an overview of Web3, then I encourage you to watch my video on it. That's in the top right. The point is that today, investors are not merely looking for a hedge to the dollar, but they're looking to invest in an ecosystem that promises to transform the world in the same way that the internet did in the early 2000s. That's it for most of my comparisons here, folks. A few of my own thoughts here, though. When markets started falling a few weeks ago, I did silently ask myself the question of whether we could indeed be heading for another cold, long winter. 2018 and 2019 were rough, and I wanted to see whether the prognostications of doom were warranted. Well, if there's one thing that's clear from this video, it's that the two periods are almost incomparable. Researching this video has surprised me as to how much things really have changed in fewer than 4 years. The markets have evolved. More people know about crypto. More people are using crypto. The investors are different. The investors are investing based on different theses. The conditions that led to the last crypto winter are nowhere to be found. Now, this is not copium. This is not even hopium. It's pure facts. The markets are tanking right now because of factors that are way, way outside of the crypto market. A global pandemic and monetary stimulus not seen in over 100 years is pretty likely to have big implications for nearly all asset classes, and crypto is no different. In fact, part of the reason that we're seeing these moves is precisely because crypto has become such an investable asset class. Those institutional investors who allocate to equities are now taking general risk off the table. They're not discriminating between ETH and Netflix, Bitcoin and Tesla. They are worried about the Fed hiking rates, war with Russia, supply chain disruptions, pandemic variants. It's a global macro landscape, and crypto is being caught up in it. How long can it last? Well, it's hard to tell. I'm not a soothsayer, and quite frankly, no one is. These external factors are beyond our control, and realizing that is the first step to rational thinking. Those who are able to think rationally can spot the pockets of value that abound. So, over the next few months, we will see who was really, quote, in it for the tech. Whatever the markets do, I'll be here, day in, day out. What about you? That's my video for you today, folks. I'm keen to get some feedback from you, of course. So, how many of you were around in 2017 and 2018? Do you think the markets have changed considerably since then? I'd love to know in the comments below. Also, while you're down there, I have something extra special for you. Hello again. Forgive me. I just a couple of points that I neglected to keep you abreast of earlier. Yes. So, If you want to see more from Guy, then it would be spiffing if you went and had a look at his Telegram Insider channel, where he gives you a daily market analysis. There's also his Twitter for all the latest from the Coin Bureau, as well as Instagram and TikTok, which I must confess I've never heard of. There's also his weekly newsletter, where he shares crypto tips and a breakdown of his personal portfolio, yes. And I should add that it's once weekly with a no spam guarantee. I used to rather enjoy a spam sandwich when I was a young Turk at Eton, but I gather they're not quite the same thing. So all the official links to what I've just been talking about can be found below. Now, be sure to visit the Coin Bureau merch store if you want to look super duper fly, and don't forget to like and subscribe and generally make yourselves amenable. Right, that about wraps it up, I think. Anything else? No? Right. Goodbye and good luck.